Barry Ritholtz is the founder and chief investment officer of Ritholtz Wealth Management, a longtime veteran in the investing community. He is also author of the new book, How Not to Invest, the Ideas, Numbers, and Behaviors That Destroy Wealth and How to Avoid Them. Barry, my man, welcome here to Leading Indicator. Congrats on the new book.
Thanks so much. It's a pleasure to be here.
So the book is all about the ways how not to invest, maybe counterintuitive from a lot of the other self-help investing books out there on the market. Why is avoiding mistakes more powerful than trying to explicitly go out there and chase some alpha?
Sure. We've had a century of books coming out telling us what to do. Buy this, sell that. Here's how to trade options. Here's how to follow a trend. And yet most of us are all pretty mediocre investors. Charlie Ellis, one of the two Charlies I dedicate the book to, taught us back in the 1970s that investing is like tennis. It's two games in one. It's a winner's game and a loser's game. Most of us aren't professional tennis players. We don't win by serving aces, hitting with power and accuracy, keeping it away from our opponents, putting a lot of spin on it. We lose through unforced errors. We double fault, we hit into the net, we hit long, we hit wide, we hit it right into our opponent's sweet spot. And he drew the parallel that investing is the same way. There's a tiny handful of unicorns who have crushed it, picking stocks, timing markets, doing all sorts of positive things. Most of us aren't Peter Lynch or Warren Buffett. Most of us hurt ourselves through these unforced errors. If only we can avoid those, we'd be so much better off.
Barry, I wonder what are some of those most frequent unforced errors that you're seeing or you're hearing investors make in this current market, this current era where uncertainty is certainly the name of the earnings season and no one exactly knows what the tariff policy is going to bring tomorrow?
Yeah, the tariff situation is kind of fascinating. I'm guilty of this failure of imagination as well as everybody else is. The president has been talking about tariffs pretty much his entire adult life. Tariff is the most beautiful word in the dictionary. I'm tariff man. None of us imagined that anyone would put Pax Americana at risk, the dollar as the reserve currency, the huge economic benefits the United States has enjoyed since the post-World War II era. But it's just another example that nobody knows what comes next. Nobody had on their bingo card global pandemic, right? Think about the year ahead, December 2019 forecasts. Global pandemic closed the global economy. Oh, and by the way, stocks are going to do great that year. And nobody had the Israeli-Hamas war or the Russian-Ukraine war. The world is simply too random and too complex to be able to accurately forecast what comes next. And so you have to build a more robust portfolio and have a little more humility.
Barry, I wonder how you've seen investor sentiment, investor psychology shift. We are in a fundamentally new era of investing between meme stocks, algorithmic-driven trading, AI trades, zero-dated options. The game looks in many ways a lot different, and some would say a lot more speculative or short-term today than it has maybe for years past for a lot of investors. But does the psychology stay the same regardless of the gamification era, or have you noticed a significant shift, I wonder?
So there are always punters who show up and have discovered the stock market. The gamification, the meme stocks, that's nothing new. Go back to Kennedy Sr. talking about the shoeshine boys giving him stock tips. How are the meme stocks any different from what took place a century ago? Look, the technology that underlines the market structure of look where you are. You see how it's become faster, more electronic, more integrated into global communications. But human nature has not changed. We are still driven by fear and greed. What is more frustrating to any investor than seeing your idiot neighbor who, let's all admit, he ain't that smart, but he's making a ton of money? Nothing makes us more crazy. Nothing stimulates FOMO quite like that. And so fear and greed is what's going to drive our impulses. And you see that reflected in market action.
How can investors avoid temptation for instant gratification? And in your career, what have you seen those sorts of temptations to look like? So this is very counterintuitive, but what I'm going to say is give in to temptation.
People are like, what? Why should I do that? In the book, I talk about setting up a cowboy account. I started on a trading desk, and I'm a junkie. I am looking for that dopamine hit. I love that. And so take 2, 3, 4% of your liquid net wealth, put it into an account, and if you want to buy zero-dated options or buy deep out-of-the-money calls when the market's down 15, 20%, have at it. But remember, if it crashes and burns, if it goes to zero, well, thank goodness it wasn't your real money. And if it does well, could you imagine staying fully invested when something doubles or triples and it's your entire net worth? When we see people with big holdings in Amazon or Nvidia or Apple or Bitcoin for that matter, those folks are the exceptions. Most people who were early into those stocks, they simply can't hold it. It's too much money for them not to ring the bell. And so if you're that sort of person, if you have that itch, well, rather than fight it constantly, use a little bit of money to scratch that itch. But by all means, please make sure your big dumb lizard brain leaves your real money unmolested. That's what I do. I make sure my cowboy account leaves my real money untouched.
Barry, what are some of the biggest myths or the pitfalls that you're seeing investors fall for today?
So we suffer from a lack of humility on Wall Street in general, but a lot of that spills over to Main Street. When I was starting out in the 90s, some of the big houses had these training programs, and I used to think it was like an MBA or a graduate degree, but I have enough friends who have gone through the big programs to learn. You spend the first week learning modern portfolio theory, how to create an asset allocation plan, how to build a bond ladder. That's the first week. The next 51 weeks for the rest of the program is all sales training. And so there's very much this fake it till you make it sort of attitude. Everybody is very confident, very self-assured. They want to make sure their clients have faith in them. And I think that kind of leads us to imagine we know more about what's happening today than we really do. And that leads us to imagine we know what's going to happen in the future. And hey, if this year doesn't convince you that nobody knows what the hell's going to happen next, I don't know what will.
Not even Barry Ritholtz.
I'm as ignorant as anybody. Look, you could go back to the wisdom of Aristotle and Socrates, who wrote, the one thing I know is that I know nothing. I mean, I don't want to get philosophy 101 back in college, but once you recognize, and we've seen this with lots of really successful investors, Ray Dalio's first book, Principles, talks about the advantages of making mistakes. Every time you make an investment mistake, it's an opportunity to learn from that error, figure out what you did wrong, figure out what you should have done, and incorporate that into your model going forward. Most of us make the mistakes. Few of us follow what Ray Dalio did and build a wildly successful hedge fund based on constant improvements. We can take a page from that.
Now, Barry, if you don't mind me asking you personally, what is your dumbest investing mistake and what did you learn from it?
So I'll give you an omission and a commission. I'm a big Mac fan, had a Mac Classic in grad school in the 80s. And so in the early 2000s, when I got my hands on one of the early iPods, not iPhones, not one of these, but iPods, at the time, Apple had cost $15 a share with $13 in cash. Wait, I'm making a $2 bet that this is going to replace the Sony Walkman, 1,000 songs in your pocket. Great. And I remember buying it, recommending it to the firm at $15. And we bought an ungodly number of shares, but then I start seeing the reports at $20 and the brokers were selling it. What are you guys doing? This is just getting ramped up. Hey, up 33%, got to ring a bell. Take the win and move on. So I was going to show them. I held on to it till it tripled, till it went up to 45, and then I sold my personal shares, and then proceeded to watch it run another 5,000% and become the biggest company in the world for a while. So that was a sin of commission. I was behaving like a trader instead of behaving like the investor I had become. The sin of omission, and because I call out so many people in the book, I have to call myself out. The sin sin I talk about. I'll keep this G-rated, but I'm sitting with the Oakland Bridge in the background at the seaport in San Francisco, and Howard Lindzen is pitching me this startup that's going to let millennials trade for free. Howard, that's the dumbest effing idea I've ever heard in my life. They don't have any money. How are you gonna monetize this if you're not trading? Well, this just seems, aside from the fact that it's totally off brand for everything we did, that pass turned out to be Robinhood, and I don't even want to calculate how many tens of millions of dollars I missed out because I thought I understood venture investing when I hadn't the slightest clue how to do seed investing. So, learning what you're good at and trying to trade within yourself, invest within yourself. I'm a big car fan. You could see behind me. And when you take the high performance driving classes, really they're secret defensive driving schools because they're trying to get you to understand what your limits are and the automobile's limits are. And as long as you stay within those limits, hey, the car stays on the track. But if you throw yourself into a turn 50 miles an hour faster than the rubber and the chassis can handle it, you're going to end up hitting the wall. Learning to stay within your own capabilities is the key, and that's how you avoid unforced errors.
I really appreciate the candor behind that full answer, Barry. What is one lesson in investing that you wish you had personally learned sooner?
The power of compounding is probably the biggest and most obvious. You just can't imagine. We have not evolved and adapted to operate in an exponential world. Our world is arithmetic, right? There's two gazelle. If we capture one of them, everybody has dinner, right? You don't have to think about the rule of 72 and how often things double and double again and double again. And so that leads you to want to have started investing earlier because even a couple of bucks accumulate dramatically. And it also leads you to recognize that the biggest mistake you make when it comes to compounding is interfering with it. Let the market generate the returns for you that it will. We're all so busy chasing alpha that we sometimes forget to just lock in beta. And compounding is a constant reminder of that.
Barry, how about one piece of advice for navigating current market volatility and overall uncertainty?
Sure. We'll go back to Solomon. This too shall pass. Markets don't always go up. And we, in 2025, have become incredibly spoiled through the entire post-financial crisis era. Think about what markets have done since March 09. You had 0% interest rate for a decade. Markets more or less averaged 14% or so a year. Then you had this massive fiscal stimulus, the biggest as a percentage of GDP since World War II, and markets continued to power higher. We're having a rough sledding this year. Since President Trump was elected and a lot of this volatility began, we're down as of today a grand total of about 5%. Yeah, there was a lot of volatility. There was a lot of back and forth. I don't care what your politics was. This happens pretty regularly, although admittedly this year has been more volatile than most. But we're kind of spoiled by how good we've had it for the 15 years, starting with President Obama, then going to President Trump, then to Biden. We had an incredible run of returns from presidents of both parties. And all right, so Q4 2018 was a 20% drawdown before it snapped back. And the first quarter of 2020, down 34% in 17 trading days. Hey, that was an externality. It wasn't necessarily from within the market. And then, of course, 2022, the first time in 4 decades where we've been down double digits in both stocks and bonds the same year. That's kind of a rare event. 23 plus 25% of the markets, 24 plus 25% of the markets. I told clients in our quarterly conference call in the beginning of the year, when we look at back-to-back 25% years, and we had to use plus 20% as our framework because there were so few back-to-back 25% years, The forward expectations are just lower your expectations. When you get two 25% years in a row, you're up a little, you're down a little, but two 20% years in a row. But don't expect that to continue forever. That's about 5 years worth of returns in 2 years. Throttle back, take 4, 5, 6% if we get it this year and be happy. You made so much money the past 2 years, you can't expect trees to grow to the sky.
Finally, Barry, before I let you go, what is the biggest story in the world of business, markets, or investing that you think we are not talking enough about?
Wow. I'm kind of fascinated by all the advances in medical technology. And not just longevity, but quality of life that's going on. I don't know if people are aware of how much progress we've made conquering all sorts of diseases. Longevity is going to be a concern. And maybe I'm wearing my, financial planner hat. One of the biggest concerns people have is, am I going to outlive my money? And if you make it to mid-60s and you had parents who lived to their 80s or 90s, you have another 30 years of life expectancy, statistically speaking, on edge, on offering. And you really need to consider how much longevity in the United States and in the Western world is improving. I don't think people have thought about that enough. We talk about AI all day, every day. We talk about robotics and automation and self-driving, and those things are headlines, but we are constantly making these breakthroughs on the medical side. Some of it's genomics, some of it's oncology, but on and on the research goes. You better be, if you're in your 30s, you better be saving a lot of money, because the odds of hitting 100 are 4x what it was for your grandparents.
Wow. Incredible perspective. A really great conversation coming at a really important time. Barry Ritholtz is the founder and chief investment officer, of course, of the one and only Ritholtz Wealth Management. The new book is called How Not to Invest, the Ideas, Numbers, and Behaviors That Destroy Wealth and How to Avoid Them. Barry, congratulations on the book. Thanks for being here.
Thank you so much for having me.